Today we're going to discuss one of my favorite topics, calendar spreads. I have been trading calendar spreads just about every day the market has been open for the past 25 years. I love calendar spreads. But before you ever plunk down real cash to buy a calendar spread or any option spread, first you should check out what the spread will make or lose when the short options expire at the various possible prices where the underlying stock might end up. Fortunately, this is easy to do with a Thinkorswim Analyze tab. Let's check it out. Here's the Analyze tab. We have selected SPY, the S&P 500 tracking stock. It's one of my favorite underlines, and I'll explain why in another video. First, we'd have to do a little housekeeping. We want to change that to PL day. And down here, since we are going to be selling March options, we want to change this date to one day after those March options expire. So let's go up and buy a calendar spread. SPY closed at 136.41 last Friday. This is over the weekend now, but after hours trading, it went up to 136.67, and that's going to be the number that we're going to be working with. So let's buy a calendar spread at a slightly higher strike than that. We'll look at the calls. We will buy a calendar, and we'll go down here and switch to April. And when you buy a calendar spread, you buy an option with a longer remaining life and use that option as collateral to sell someone else an option with a shorter life, the same strike price. Since all options go down in value each day, we make our money because the March options go down at a faster rate than the April ones. In fact, when the March at the 137 strike, if the price is the same today as it is then, these March options will expire worthless, and we will still have our April options left. That would be our profit. This little box here explains what the profit is with this calendar spread at the various possible prices. If the price stays exactly the same, 136.67 at expiration, we go over here and we see we make $1,000 profit. Now we have spent down here, this calendar spread is going to cost us $1.40 or $140 per spread. We've bought 10 spreads, so we've invested $1,400, and if the stock price stays exactly the same, we're going to make $1,000 on a $1,400 investment, which works out to be almost 72%. Well, let's just check if maybe there's some other way we can even improve this. First, let's check what would happen if we change, instead of buying calls, we buy puts. Usually, when we buy calendar spreads, if the strike price is less than the stock price, we buy puts. And if the strike price is greater than the stock price, we buy calls. I'll explain why we do that in another video. But at very close to the stock price, both strikes, we want to check to see if puts or calls are a better deal. In this case, the potential gain is much greater with puts. Remember, it was about $1,000 with the calls. Admittedly, instead of paying $1.40 for the spread, we're going to have to pay $1.55 for this one, but the potential gain is gone from 72% up to almost 89%. So in this case, puts are clearly a better alternative, but we should always check that with this Analyze software before we place the spreads. Let's also see, maybe we ought to be going out further than April. What would happen if we go out to May? In April, remember, we're making almost 89%. But if we change the long side to May, we make a greater absolute profit, but we have to make a much greater investment, and the return on investment goes from almost 89 down to 59. So clearly, buying the May options is not nearly as good a deal as buying the April options. So let's look at the risk profile graph for this single calendar spread. This is a typical graph of what we could make or gain with a single calendar spread at the 137. The maximum profit is if the stock ends up right at that strike price, 137. In this case, we make close to 100% if it closes right at 137. However, if the stock fluctuates in either direction, you make far less money. But the nice thing about calendar spreads is it can go quite a ways before you lose money. On the upside, you can go all the way up to 141 before you encounter a loss. Downside, always all the way to 133 before you encounter a loss situation. And with calendar spreads, you never can lose everything because the value of your long positions will always be greater than those of the short positions. No matter what happens, you will have some incremental value. You can't lose all your money. Anyway, this is one way of doing calendar spreads. Buy a single calendar and a single strike, and you sort of wait, see what happens. If the stock goes up here, well, all of a sudden we're getting a little edgy because maybe if it goes further, we're going to lose money. So you might buy a second calendar spread at that point at a higher strike price and spread your risk over more than one maximum gains. That's one way of doing it. Another way of doing it, which is what I prefer, is to buy more than one calendar spread at the outset. Let's say we bought some 135 calendars as well. Change this to April down here and see what that looks, how that changes the risk profile graph. Now we see instead of a single point where we make our maximum gain, we've got a range of almost $2 over where we get the same return. The return's a little bit less. We're down to about a 71% total gain for the month, but certainly we'll take that if we can get it. But it's like betting on 2 horses or 3 horses rather than one. Now when I look at this, I say, okay, I like this flat thing here, but if the stock goes up $3, we're only going to make a very small amount, whereas if it goes down $3, we're going to make a lot more. So let's balance this out a bit and put a third one on. And this time we'll do 139. We'll buy a calendar at 139. Go down here and change this to April. Let's see what that looks like. Okay. So I like the fact that it's fairly flat here, but I got a big bump right here. I want to make it flatter than that. That's at the 137. So I can reduce that bump by going down here and buying fewer calendar spreads at that strike price. Now you can see it's leveled off a bit. So I look over here and now I see that if the stock goes up $3, I'm going to make a whole lot more money than if it goes down $3. I can fix that by going down here and reducing the number of calendar spreads we buy at that 139 strike. We switch that to 7. Now we're over here. We make about 20% if it goes up $3. We make almost 20% if it goes down $3. And we make a whole lot more if it's anywhere in the middle. So this is the second way that you can set up calendar spreads at several strikes. I particularly prefer this because you've got a wider range over which you can enjoy a decent profit. Buying calendar spreads in the first place is the easy part of carrying out a successful options strategy. The second part is the tough part. We can see that if the stock price doesn't fluctuate much, calendar spreads do very well. But when the stock price fluctuates in either direction, calendar spreads face a possibility of losses. When a big fluctuation takes place, an adjustment becomes necessary. If the stock moves up about $1.50 or down $1.50, we would have to make an adjustment to make this curve shift to the direction that the stock has moved. Making adjustments will be the topic of another video soon.